Hello and welcome to The Upside. I'm Nicole Coriale. Tax season is here and it comes with a flurry of questions, concerns, and the occasional myth that just won't quit. Today, I'll set the record straight with two tax and estate planning experts who know the ins and outs of how to make smart financial decisions and the most of your investments. I'm pleased to be joined today by Jacqueline Power, Director of Tax and Retirement Research, and Giselle D'Souza, Tax and Estate Planning Director. Welcome.
Thank you.
So they say that there are two absolutes in life, death and taxes, and I personally fear both. And I think I can positively say that I'm not the only one in that camp because there's a lot of changes when it comes to tax policy, and it can be hard to keep up and seem very overwhelming. So today I want to sort of break down, all these buzzwords that we hear, TFSA, FHSA, and then also take a deep dive and unpack. You both did a Reddit AMA on our Fidelity Canada subreddit a few months ago, which was extremely informative session. Investors and viewers asked questions, anything they wanted to know about tax and estate planning, and you answered them so eloquently. So today we're gonna unpack that further. But like I said, there are a few acronyms: TFSA, FHSA, RRSP, RESP. All a few letters short of, like an Aretha Franklin song. But very quickly, high level, I want to break down what each of these mean. TFSA, I'm on TikTok, and there's a lot of discourse around the confusion around it, actually, with young millennials and Gen Z. So Giselle, what is a TFSA?
So a TFSA is a tax-free savings account. And so what it is you can set aside money and have it grow tax-free once you reach the age of majority. So it says savings account, but it's actually an investment account. So any investment income that's earned in that account is not subject to tax. There's an annual contribution limit that's $7,000 for 2025. And the way it works is it accumulates. So once you reach the age of majority, you start to accumulate that room. So when the account was introduced in 2009, if you had already been the age of majority, you could currently put $102,000 in that account and then have that grow tax-free and take out that money whenever you need it.
And who's eligible?
Anyone who's Canadian who's over the age of majority, so that'd be 18 in Ontario.
Okay, fantastic. Jacqueline, FHSA.
Yes, so this is the first home savings account. So essentially what happened was the government realized a lot of Canadians weren't able to purchase a new home because they couldn't save enough money with high real estate prices and that sort of thing. So in April of 2023, they introduced the FHSA. Essentially, it's the best of both worlds between a TFSA and an RRSP. So essentially, it grows tax-free. If you make a qualifying withdrawal from it, which is to purchase a first home, then it is also tax-free. You're able to contribute $8,000 a year. And the great thing where it's sort of like an RSP is you get a deduction for that contribution. So that reduces your taxable income. So really beneficial. And the lifetime limit somebody can contribute is $40,000.
And this is eligible. Who's eligible for this?
Oh, same thing. So it would be somebody who's a Canadian resident. They have to be age of majority and have a valid social insurance number.
Okay, fantastic. So you mentioned RRSP, Giselle. Let's unpack what that is.
So RRSP is a registered retirement savings plan. So where a TFSA and FHSA are tax-free, this is actually tax deferred. So the money you put in, you get a tax deduction for it today. And then when you withdraw it in the future, you pay tax on that withdrawal, with the end goal being that hopefully you're in a lower marginal tax bracket in the future. And then you can use that deduction today to bring you to a lower marginal tax bracket. So in terms of what you can contribute, there's an annual limit of either 18% of your income or whatever the maximum is for the year. This year it's $32,490. And whatever is the lower amount is the maximum you can contribute. And similarly, it accumulates. So if you haven't maxed out your contributions in previous years, you can max them out whenever you have the contribution room available.
Okay. And how does that differ from an RESP?
Yes, so an RESP is a registered education savings plan. So with this one, it's a way that parents or grandparents can save for a child's education. With this, there's no annual limits as far as contributions are concerned, but a lifetime limit of $50,000. There's grant as well that can be available. So you need to make contributions to the account in order to be able to receive grant. Grant is 20% to a maximum of $500 a year and a lifetime limit of $7,200. So it's nice to see that the government's putting dollars behind this and trying to help with children's education.
So you could essentially have all 4 of these. That's a lot. All right. And there was one other thing you wanted to touch on.
Yes, so once you've maxed out all of these registered accounts, the next option is a non-registered account.
Right.
So this is taxable. Any interest, capital gains, dividend income earned in a non-registered account is taxable. But if you have it managed by an advisor, those fees that you pay your advisor would be tax deductible. And so really, generally, unless there's a specific reason you need it in a non-registered account, the school of thought is you max out your registered accounts and then put money in your non-registered account.
Okay, fantastic. So now that we've sort of have the basics down, we couldn't have this conversation without touching on the marquee tax topic of the year, which is the capital gains inclusion rate that has seen many changes since, I guess, last year. Yeah. So Jacqueline, if you could just sort of walk us through what has been happening with capital gains.
Ton. So it's been pretty crazy. So essentially in April of last year, the budget proposed to increase the capital gains inclusion rate to 2/3. So that was supposed to be effective June 25th of last year. For corporations, the 2/3 inclusion rate, and for trusts as well, it was right away, like as of the 25th. For individuals, we had a $250,000 threshold where we were still able to use the 50% inclusion rate, and then anything above that was the 2/3 inclusion rate. Now, where the issues arose is that this never passed. So the legislation never passed. And then when Prime Minister Trudeau prorogued government, essentially what happens then is any legislation that hasn't passed is essentially dead. So that's why everybody was saying, well, the capital gains inclusion rate is dead. And that's true. At this point in time, it is. But it could be reintroduced when government comes back at the end of March. Now, with all of this confusion, there was a lot of pushback as far as tax preparers, Canadians in general, that sort of thing are concerned, because nobody knew how to file their taxes for last year. So thankfully, the government has now pushed off the date. Instead of it being June 25th of last year, it's now January 1st of 2026. So any gains this year are still going to have that 50% inclusion rate.
Okay. And it gives people more time
exactly
to figure everything out, because it was, very, very confusing. I think, it gives tax a bad name. It's like, what's going on? There's always something, I find, and it's like a headache. Okay, great. So I'm so happy that we sort of unpacked the basics there. I want to dive into these viewer questions. Giselle, we'll start with you. This viewer asked, what are tax obligations when someone withdraws from an RRSP account before he or she retires? Are there any fees or penalties other than taxes that a person can incur when he withdraws from an RRSP before retirement? The withdrawals are not for a home.
That is a great question. So when you withdraw from your RRSP, the amount that you withdraw is going to be included in your income as regular income, so you're going to have to pay tax on that similar to your employment income. However, one thing to consider is when you withdraw from your RRSP, there is withholding tax on the withdrawal. So it depends on the amount you take out. Up to $5,000 is 10%, 19% in Quebec. $5,000 to $15,000 is 20%, 24% in Quebec. And then anything over $15,000 is a 30% withholding rate, 29% in Quebec. So what this means is, say you needed $100,000 and you're going to pull it from your RRSP. If you were, let's say, in Ontario, you'd actually need to take out $143,000 to account for the withholding tax at source. When you eventually file your tax return, if the amount of tax you have to pay is less than the amount that was withheld, you'll get a refund. But if you need it for something in the interim, you would have to over-withdraw to account for that withholding tax. Another thing to keep in mind is once you withdraw from your RRSP, you don't get that contribution room back, so you would lose that contribution room. If this individual is looking to get regular withdrawals from the RRSP and they're over the age 55, they can consider converting it to a RIF. When you have a RIF, there's a minimum annual withdrawal that you have to take based off of your age, and so that's a good way to start pulling income. But again, if they want to pull out more than that minimum withdrawal, they would be subject to the withholding tax. They did mention this isn't for a home, but I think it's worth noting that there are two specific circumstances you can pull from your RRSP and put the funds back. One is if you're purchasing a home. For the home buyer's plan, you can take up to $60,000 out. And then there's the lifelong learning plan where you can take $10,000 for continuing education up to a $20,000 maximum in your lifetime. And both of those amounts can be paid back.
Okay. Thank you. And thank you for that question. Jacqueline, for you, this investor wants to know, if I invest and withdraw the money in 7 or 8 years, is an RRSP or a non-registered account more tax advantageous? Please expand on the types of taxes that would be involved with both options. Thank you.
Amazing, great question. So with this one, it's generally better to save within a non-registered account rather than a registered account. And the reason is, with an RRSP, we have, as Giselle was mentioning, there's a finite amount that we can put into our RRSP. When we make that withdrawal, as she mentioned, we don't get that RRSP contribution back. So it's if you're looking to save for short term, generally doesn't make sense. Also, from a tax perspective, if you're withdrawing from your RRSP, it's fully taxable as income. So not overly advantageous for them. Whereas if you're looking at a non-registered account, much more tax efficient. Essentially, at the time the withdrawal is made, it'll look at what the fair market value is, what the adjusted cost base is. Difference between the two of that is the capital gain. And as I mentioned, that's at a 50% inclusion rate right now. So much more tax efficient with respect to that. Now, one thing that they didn't ask about that I think is where they should be saving is a tax-free savings account. If you're looking for short-term purchases and you have availability to contribute to your TFSA, that makes sense because the contributions grow tax-free, withdrawals are tax-free, and what makes it even better is January 1st of the following year, you get that TFSA contribution back. So really advantageous for them.
Fantastic. Giselle, this investor wants to know, I've maxed out all my tax shelters, RRSP, FHSA, and TFSA, and now have to invest in non-registered. What do I need to know for tax purposes? How do ETFs play into this? I know there is something called ACB, but do ETFs function as multiple buy-sell because they hold so many things? And if you could just also unpack what ACB is.
Yes, for sure.
Okay.
So great for this person that you've maxed out all of your registered accounts. That's amazing. So like I mentioned before, when you have a non-registered account, any income that's earned in that account is taxable. So your interest income, your dividend income, any of your realized capital gains, you will have to pay tax on that. If you had a return of capital, that would not be taxable. So any income that's generated in this non-registered account would be subject to income tax. In terms of what ACB is, so that stands for adjusted cost base. And so that's the amount that you pay for a security plus any expenses, so commissions to buy the security. Specifically relating to ETFs, so ETFs are exchange traded funds. They're usually baskets of securities based off of a specific theme or strategy or approach to investing. So what it allows investors to do is maybe diversify instead of holding a single security. When you sell an ETF, you're selling a unit or units of that. And so it's not multiple buys or sells, you're selling a unit of the ETF itself. And so it only counts as the buy or sell of that unit of the ETF.
Fantastic. Jacqueline, to you, this viewer would like to know, I am closing on a house next year. Congratulations, September 2025. Should my FHSA contribution next year yield me any tax benefits? Because I will be contributing in 2025 and withdrawing in 2025 as well.
Great question. So with this one, the FHSA doesn't have any requirements as far as having the money in there for a particular period of time before it can be withdrawn. So she would definitely, or he would definitely be able to make that contribution, withdraw it right away, can still use that deduction in 2025 if they would like. Now, what I find a lot of the time with the FHSA, it's a lot of young Canadians, a lot of the time who are setting them up. Frequently, they don't actually need the deduction right away. So it's important to know that you can carry that deduction forward indefinitely. So once your income is higher and it makes more sense for you to use that deduction at that point, you can choose to use it maybe 5 years down the road.
Right. Okay. Switching gears a bit here to early retirement. So going from maybe a young individual who's buying their first home. They want to know, most advice about early retirement is based on living in the United States. What advice do you have for Canadians who want to follow that path? Things such as knowing about 4% rule, planning appropriately for lower CPP, or anything else you have in mind would be fantastic.
So congratulations to this user for retiring early. I wish I was in such a position. Yes. So things to keep in mind. It's good to look at what your pension from your employer is, how much you're expecting to get, what the balance in your RRSP is, kind of trying to see if you can sustain your lifestyle expenses based off of what your sources of income will look to be in your early retirement. Specifically, they asked about CPP. So the average age you take it is 65.
Right.
The latest you can take it is 70, but the earliest you can take it is 60. So
Okay.
I don't know how old this user is, but they
Right,
won't
right.
be able to access it until they're
Right.
age 60.
Okay.
But there is a penalty almost for taking that. So you get 0.6%
Right.
less per month if you take it from 60 onwards up to 36%. So that is something to keep in mind, that you would be getting less CPP.
Right.
They should maybe potentially consider talking to a financial planner who can look at all of their different sources of income and kind of project out whether or
Right.
not they'd be able to sustain their lifestyle from a financial perspective. That might be beneficial. But another consideration is, it's great to think about early retirement, but the actual reality of going from having 8 hours of work a day to having 8 hours of free time a day
Yeah.
could be quite a significant change. So just making sure that they're mentally prepared for that big lifestyle change. And as Fidelity actually prepares a retirement report every year that talks about the Canadian retirement landscape. And so
Right.
that might be great to offer them some insights into what
Right.
the retirement
Right.
landscape looks like right now.
And because they should speak to an advisor, because it might be even beneficial for them maybe to wait instead of taking it early.
Yeah, you
at
could wait till
60.
age 70.
Yeah.
Similarly with old age security, you can
Yeah.
take it at 65, but if you wait till age 70, you get an additional amount.
Right,
So
right.
great to talk
So
to
many
someone.
factors to, your health, like you have to take all these things
Oh yeah,
in,
there's
right?
so many factors to consider.
Yeah. Okay, fantastic. Thank you. And our last question here is from a viewer who wants to know, for retirement drawdown plans, if the goal is to minimize tax obligations for the beneficiaries, would the order of withdrawal be RRSP, RIF, non-registered investments, then TFSA?
So it depends, and that's the whole thing with tax, right? It always depends on the situation. So yes, generally it makes sense in many situations to withdraw the RSP or the RIF first, because at the time of our passing, especially if you're concerned for beneficiaries, because when we pass away, we're considered to have sold all of our assets. So that RIF or that RSP is fully taxable as income. So it can throw somebody into the top marginal tax bracket, and it can be over 50% is what that's going to be taxed at. So starting to melt that down frequently makes a lot of sense. But you really need to work with a tax professional, work with an advisor to see what makes sense. Generally, it makes sense to have a mix of everything. You want to have some registered income that you're pulling, some that you're pulling from your non-reg assets as well, and possibly even a TFSA. That's another great way to supplement retirement income, especially for individuals who are worried about OAS clawback, because it allows you to have this income, but it doesn't affect your net income. So it's not throwing you over that threshold as far as the OAS clawback is concerned. So for this, I would say it really depends on the individual, and important to work with that advisor and the tax professional.
Thank you so much. This has been so informative. I feel like I have to say thank you for your service, your duty to all of us to help us better understand how to approach taxes and estate planning and retirement, because it's important. It's maybe dull, but important.
Not to us.
Yeah, not to us. Others would argue that, but so thank you very much. If young investors have any sort of, if they have more questions, who would you advise that they speak to?
I would say a financial advisor is
Right.
a great place to start, for sure, and they'll be able to sort of at least get the ball rolling.
Right.
It might make sense to speak with an accountant, depending
Right.
on what kind of questions they have.
Okay. Perfect. Well, thank you both so much for joining me today. And thank you for joining me on The Upside. As always, if you have suggestions on future topics or guests you'd like to see on the show, please share your ideas with us. And be sure to join the Fidelity Canada subreddit to not miss any upcoming AMAs. Thanks for watching. I'm Nicole Corielli.